In 2008, Warren Buffett made a bet, $1 million, that a simple, boring index fund would beat a team of expensive hedge fund managers over 10 years. He won. Not by a little. By a landslide. But here's what most people don't know: the fund that beat Wall Street's best minds is only half the story. There's a second product that does almost the same job, but works very differently, and picking the wrong one could cost you more than you think. Never forget to like the video, subscribe to the channel, and turn on the bell notification so you never miss any of our future videos. Buffett bet on one plain index fund tracking the S&P 500. His opponent, a firm called Protégé Partners, bet on a hand-picked group of hedge funds. Over 10 years, those hedge funds, despite charging much higher fees, badly lagged behind. The boring index fund quietly crushed some of the most expensive investment talent in the world. Why? Picking winning stocks again and again is hard, even for professionals. And high fees quietly eat your returns every year. That's the whole idea behind index funds, and it's also built into most ETFs today. Think of it like a sampler platter instead of gambling on one dish. An S&P 500 index fund gives you a small slice of all 500 biggest U.S. companies, Apple, Microsoft, Coca-Cola, in one purchase. Take Alex, a teacher in Ohio. Every payday, part of his salary auto-invests into an index fund. He never checks it. 20 years from now, he'll likely beat most people who spent hours picking stocks, simply because he never panicked and paid almost no fees. Index fund fees are often just 0.02% to 0.20% a year. On $1,000, that's 20 cents to $2. One detail most videos skip: index funds are priced only once a day, after the market closes. But many require a minimum to start, often $1,000 to $3,000. Now meet Priya, a student with only $60 saved. An index fund's minimum is too high for her. So she buys one share of an ETF tracking that same S&P 500, no minimum, cheaper than a textbook. ETFs bundle stocks just like index funds, but trade on the stock exchange like a company share. The price moves all day, and you can buy or sell anytime the market's open. Sounds like a clear upgrade. But there's a risk here most beginners have never heard of. On May 6, 2010, U.S. markets saw what's now called the flash crash. In minutes, some ETFs briefly lost over 90% of their value, not because those companies became worthless, but because trading itself broke down during panic selling. Prices recovered within the hour, but anyone whose sell order triggered during that window locked in real losses. Index funds can't do this; they're priced once, calmly, after close. The same real-time pricing that makes ETFs flexible can turn against you in extreme moments. There's also a quieter cost: the bid-ask spread, the small gap between an ETF's buy price and sell price. On huge ETFs like VOO, it's tiny. On smaller ones, it quietly eats your returns over time. Not every ETF just tracks an index. ARKK, for example, has a manager hand-picking tech and biotech bets, trying to beat the market. According to Morningstar, only about 3 out of 10 actively managed funds actually beat the market long-term. Most of the time, you're paying extra for a bet that usually loses. Selling one fund to buy another, index fund or ETF, is a taxable event in the US either way. The real advantage isn't the product, it's the account. Inside a Roth IRA or 401k, either one grows tax-free or tax-deferred, which matters more than the wrapper. A 10-year bet between a legendary investor and Wall Street's smartest managers ended with one lesson: simple, cheap, and patient beats clever, expensive, and impatient almost every time. Whether you choose an index fund or an ETF, the real secret was never the product, it's staying in the game long enough to let it work. If this changed how you think about investing, subscribe. We break down the real story behind your money every week. See you in the next one. If you find this video helpful, do not forget to like the video, subscribe to the channel, and press the bell icon so you don't miss any future videos. Thanks for watching, and we will see you in the next video.